Today, words such as ETF, mutual fund, and passive investing are commonplace in the investment world. But that wasn't always the case. In fact, 30 years ago, hardly anyone on Wall Street knew what passive investing was. Hi, my name is Neil McIver at McIver Capital Management at CG. Now today, I'm going to be discussing the rise of passive investing, what it is, the benefits and drawbacks, and importantly, if it will work into the future. Over 30 years ago, and previously working with professional institutional investors, really as an order taker, I began working with individual investors. And I was not very impressed with the average stockbroker or investment advisor. It seemed to me like the Wild West, not unlike that movie, Wolf of Wall Street.
Is this stuff regulated, or what are you doing here?
Clients were being sold stocks based upon very little research, often based upon commission rates or new issue commission, and clients themselves had very little information on how much risk they were taking and at what rate of return that they were achieving inside of their portfolios. While this was going on, I was looking for a more structured and professional process to manage my own clients' portfolios. This eventually led me back to my institutional roots, where we began employing a very sophisticated Nobel Prize-winning mathematical process used by virtually all significant investment institutional investors, which is based upon modern portfolio theory to build and manage our client portfolios. We still use this process today. And the long-term track record of our performance and success of our model portfolios is self-evident. We'll put a link directly in the description below, and you can check out the performance for yourself. Now, one of the basic building blocks of those portfolios was created back in the 1990s when the very first exchange-traded fund in North America was created, called TIPS, which stood for Toronto Index Participating Fund. It was a one stock which was available to buy on the equity market like any other stock, and it tracked the TSE 35 index. Effectively, it was the entire portfolio in one position, and it rocked the boat. TIPS was met with huge resistance on the investment industry. It threatened many parts of the industry on many levels, particularly their revenue stream. But I loved it. TIPS was soon followed by a similar exchange-traded fund in the US for the S&P 500 called SPDRs, which I also loved. And so began the very first truly passive investment vehicles. Now, these are called passive because they track markets automatically and have low to no fees. These core exchange-traded funds, now called ETFs, automatically own the entirety of the market in the correct percentages based upon market capitalization of each of the underlying stocks. So the management cost is as close to zero as you're ever going to get. Over time, these core ETFs grew in popularity and more became available. Many funds began tracking sub-indexes such as the growth index and the value indexes. Then they further stratified also into industry types as well: technology, energy, housing, etc. As they did this, ETFs began to eat the lunch of the mutual fund companies. And with good reason. Studies have shown that mutual funds repeatedly underperform indexes over 80% of the time. After all, who wants to pay heavy fees only to underperform the broad market index 80% of the time? Thank you for watching. Click the link below to book a meeting with us or subscribe to our channel for more interesting content about markets and economics.